Hello, I'm Ali Selby and welcome to Livewire's newest show, The Pitch, where we interview fund managers from across the country for their ideas and insights. Today we're talking all about positive cash flow, and to do that we're joined by L1 Capital International's David Steinthal. Thank you so much for joining us today, David. I'm really excited for this chat. L1 Capital International invests in businesses with growing free cash flow, among other factors, of course. Why is that important in today's market environment?
Yeah, so look, I think cash flow is fundamentally important all the time. I mean, it drives the valuation of a business. And if you go back a step, it enables a company to hire the right people, invest in its business, make acquisitions when they need to, buy back shares when they pay dividends. So it's always really important. It's funny because we've come out in this environment over the last couple of years where companies could get borrowing for practically nothing. Interest rates were zero. And there was a lot of capital available. So companies didn't really have a great business model and they could get funding without having their own cash flow. So companies like WeWork spring to mind. And those business models, they just haven't survived an environment where you actually need your own cash flow on a sustainable basis. And we think that's going to really continue in this environment.
Okay. In your view, how much should companies be growing their cash flows annually to be worthy of a look in the portfolio?
Yeah, so that's a really interesting question because we don't think that way about they need to meet a certain minimum amount of growth. You know, the whole industry talks about growth or value, and it's not how we think. We think about quality and value. And the rate of growth really depends on the company. So we have high growth businesses like Intuit. Intuit owns QuickBooks, which competes like Xero and MYOB in Australia, QuickBooks mainly in the US, and TurboTax, which is software to file your own tax return. And the QuickBooks business is fantastic. It dominates that industry in the US, but it's much less mature than Australia. Here, every business uses something like Xero and MYOB. But in the US, only about a third of businesses use software. And the opportunity is 10 to 15 times the size as Australia. So we think that that company can grow its cash flow 20+% for many, many years to come. But we also have businesses that are much more lower growth cash flow, but steady compounding businesses, like Coca-Cola Europe Pacific Partners. It bottles Coke. It actually bought Coca-Cola Amatil in Australia a couple of years ago. And that's like a steady compounding business. And we also have cyclical businesses in the portfolio. And sometimes the best time to invest in cyclical businesses and when they're not producing a lot of cash flow. The cycle's at a down point, so they look expensive, they look like they're not generating a lot of cash, but you're investing with an eye to the future. So there's no short answer about how much they need to grow cash. It really depends on the business and the industry that they're in.
Okay, you kind of alluded to it there, but are there any traps that investors should look out for when assessing companies by cash flows?
Yeah, look, I mean, cash flow is a lot purer than revenue or earnings. To some extent, you can just buy revenue and earnings and overexpand. Cash flow is really what's left after having actually paid all your bills and funded what you need to do to sustain the business. But still, some companies do cheat. You know, one of the things that a lot of technology companies do is pay a lot of their staff in shares. And they say, oh, it's not a cash cost, it's not a real cost. We think that's nonsense, so we adjust for that. We don't give them the benefit of not paying staff in cash and just using shares. And then we're really detailed in terms of how we assess valuation and cash flow. So we get into the weeds. So to give you a couple of examples, we look at businesses whether they've got needs to have cash flow for their working capital. And in this environment that we've been in with a lot of inflation, a lot of companies have actually used a lot of their cash flow to fund their working capital, inventory and receivables. So businesses that get paid before they have to pay their suppliers, they've got positive cash flow and that's a real advantage. And another one would be tax. During COVID times, a lot of governments gave companies tax holidays and they said, you know, times are tough. You don't have to pay your tax today, but it wasn't indefinite. So a lot of companies are now having to pay a lot higher cash tax than what they did in the past. So just examples of where we get into the weeds to work out what's the real sustainable cash flow of a business.
Okay, well, thank you so much for your time today, David. I really enjoyed that deep dive into cash flows.
Thanks, Ali.
If you enjoyed that too, don't forget to subscribe to Livewire's YouTube channel. We're adding so much great content just like this every single week.